Hello and welcome to Tracking the Recovery, where we are focusing on the real estate sector. Over the last 4 weeks, we've spoken about how the sector is faring after a long and tough period of pain. Today, we look at how this has impacted the people who bet on this sector, the key investors, and is demand showing signs of a pickup. To discuss this, we have with us Shobhit Agarwal, MD Capital Markets at JLL India, Shahzaad Dalal, Chairman and CEO of IL&FS Investment Advisors, Vikram Goel, the CEO of HFDC Realty, Sanjaya Gupta, the MD of PNB Housing Finance, and Parry Singh, Senior Managing Director and Founder of Red Fort Capital. Both of them join us from Delhi, of course. Gentlemen, thank you so much for joining us. Shobhit, I'm going to start off with you. We've been speaking about the crisis in the real estate sector, the record inventory, the debt burden that they're carrying. But there's a huge ramification of all of this on the people, as I said, who bet on the sector. How is it looking for them?
Yeah, you're right that early investors in 2006-07, when the sector opened, took a lot of bet on this sector, with hopes of getting high returns. And what really happened, following that was two things. One, delays that were caused either because of, rules and regulations getting changed, or due to the impact of GFC. Really what ended up happening was the whole period played out much more than what was underwritten. Funds ended up perhaps making the multiple, but not really making the IRR.
I think the issues have been of execution and delay. So these have kind of made the whole sector very, very difficult in the last few years. Typically, when we entered this field, the promise was very high. And in the first 3-4 years, bore out that promise. But I think the market and the developers themselves, they have to focus very, very highly on execution. So I think they were not focused on execution. Secondly, I think we were also a little maybe naive in the way we thought. And the size of projects that we were undertaking because of the FDI rules, because most of our money came from outside India, was significantly larger than what most developers had executed prior to that. So that became a challenge. And because there was a frenzy of land banking in those days, many developers used capital to actually create land banks, thinking that this will add great value. Now, hindsight has shown us that the land banks are not that valuable anymore.
Parry, one thing that stands out is that a lot of the land valuations were completely out of whack, and a lot of private equity players bet on that. My question to you is twofold, Parry. One is, what is the impact of that on balance sheets when you go back to your investors whom you've raised funds from? And B, how are the delays in projects impacting you? Because I was looking through some of your projects that you've invested in. Many of them are not off the delivery dates, so to say. So there is a huge problem of delays out there.
Absolutely. We've had the privilege at Red Fort of having done almost 26 deals in India since 2005-04. And we've sold 18,000 homes in the process. So I can say the lessons have been manifold on residential is different from commercial. And the first thing to realize is if you focus on the bull, really the center of the market's been where the urbanization and the value growth of the market is. Everybody, ourselves included, have done really well. Now, the question became, in the frenzy, if you overpaid for land, especially as Shahzaad laid out earlier, people who did really large project and they were commercial. Commercial is a very capital-intensive business, and the risks were really big for them. And I think to get rewarded suitably would mean exits should have happened quicker, but exits take time. Now, what the beauty of what Shahzaad mentioned before is the average cycle time to enter and exit a project in India spans far greater than what people underwrote as, let's say, 3, 4, 5 years. Looks more like, jokingly, I call it the pregnancy of a real estate project in India can run as much as 8, 9 years sometimes, which basically creates the issue that Shobhit just mentioned at the outset, which is the multiples are doing well for investors, some of them who've done well. The IRRs look a little bit terrible, but on top of that, compounding for India is currency losses for people who invested in a different currency, let's say the dollar, for instance. And I remember for vintage funds of 2004, 5, and 6, the average price of rupee to dollar was in the high 30s, 40s. Now you're returning money in 60. Rupee is 60 plus to a dollar, 61. You invested at 44, let's say 45. So you're already down 15, 20%, and currency alone, forget. So anyway, it's been, overall, people are very enthusiastic about the market. In 2000, let's just say the boom started from 2005, 6, 7. And Shahzaad and I have been witnessing this, and we've had competitors, let's say, that cross more than 100 and are down to a handful.
Okay. Parry, we will talk about that at length. But Vikram and Sanjay, let me get both of you, and Vikram, to start off with you. What are the trends that you are seeing on the ground? When you're talking about the crisis, what is a manifestation of the crisis from your standpoint?
We're just talking about the residential markets, as you would want me to focus on. The demand was always there, and demand is still there. If you look at HDFC numbers of home loans, the numbers have been growing compared to last year, compared to year before last. So what has changed? I think what happened till about 2004-05 was that we would need money to complete projects and probably to launch the next project as a developer. And then came a lot of money. And which is where we started wondering, now because I'm getting money, what can I do? Rather the other way around, which was that I need money for completion. And Shahzaad just mentioned some time back saying that we forgot to focus on the cycle. The cycle is I need to get my approvals in place and I need to focus on execution. Because of which the holding cost went up and the rates went higher. So the supply was there but at a higher cost. So even if you look at what's happening in the market, it's the same organic demand of the actual user which is still there. There are few investors in the market which will always be there. There are few micro markets where demand supply mismatch is there, but broadly the demand is still there. For us, what we've seen in the last 6-7 months, which could be more relevant to what's happening today, most of the metros have sort of held on to the growth in mortgage markets, but it's the tier 2 and tier 3 cities which have started doing very well. Okay. That could be an indicator. Plus, even in the big metros, the number of inquiries which we get for home loans, even for real estate advisory, 60% of those inquiries are under 60 lakh rupees of demand.
Right.
Now, if that's an indicator...
Okay, that was also an indicator of where demand is and where the supply has been. So, Mr. Gupta, let me ask you this question. We've been talking about the record inventories that every big city is sitting on in terms of unsold houses. From your end, where do you see demand really picking up? Because we also have a very high interest rate regime right now. There are a lot of legacy issues. There's a lot of bad blood because of delayed projects as far as buyers are concerned. What's your key takeaway from what's happening on the ground?
Well, Mini, to sum it up, I would say, what is the sentiment? Till last year, the sentiments were very weak. And that has certainly improved with the new government. So we see lesser of fence sitters and decision making is happening. But as Vikram also said, I would corroborate that basically it is the tier 2, tier 3 cities where ticket sizes up to 50 lakhs is selling very rapidly. And in metropolitan cities below about 1 crore is making the rounds, and the inventory is moving. Another thing which we are watching very carefully is that there are lesser starts. So as Shahzaad also said, now developers are more focusing on their execution and delivery rather than just making new projects launch. So we are seeing a lot of delivery coming in, and that is giving a sort of reconfirmation to a prospective homeowner to start buying properties.
Shahzaad, it's been a pretty good year because I think the sentiment rub-off has had a good impact on the money raising for you as well as the exits for you. Of course, the equity markets have not been the route for exit, but it's really been about deals, to other private equity players, etc. An 81% increase in actual exits in projects as compared to last year. Do you see the momentum picking up, and do you see a lot of demand coming in and something which could really clear up your balance sheets?
So I think there is definitely a perception change, and it's aided by a number of confluence of factors, which include global factors, oil prices coming down, inflation seeming to slow down. Hopefully, interest rates will follow suit, and as Shobhit said, the lag effect of moving into the physical markets will happen shortly. So I think all this is making the community far more opportunistic now for the future, and I think lessons have been learned by the private equity players. So a lot of the funding is now going and likely to go as we raise more capital in the future from today onwards, is going to go into projects which are already started execution. So, and as I said earlier, and all my, I think, co-panelists agreed that execution is the key. And the people who can execute fast, sell fast, and be able to churn their inventory and the capital at a rapid pace will be the winners in this.
But what about the legacy problems that you have? Will you be able to exit? I mean, what is the exit?
Yes,
I mean, you've got Palais Royal, for instance, a big project over here, which is almost a symbol of what is wrong because it's been held up after about 3/4 of a completion. You're a big investor over there. Many such projects have been held up. What impact does this have?
So this could affect the IRR in some of our cases. In some cases, it doesn't affect IRR, but it definitely affects sentiment to investors because we are not able to return cash back as quickly as we wanted to. But fortunately, many of these issues are getting sorted out. In most of our exits have been exceptionally good over the last few months or last 1 year. And investors are now, as I said, looking to come back into India. A few stray cases will happen. I don't want to discuss specifics of a case, but merit, no merit, whatever it is. Those in a portfolio that we create, where we have almost 40 investments in the real estate sector, 1 or 2 will lag. Some of them will be early. So that's, I think, par. I think investors will accept that. But
Parry, how willing are investors to accept this? Because what's also happened from a regulatory environment point of view is there have been a lot of changes. What impact does that have, and how has it impacted your peers or you?
No, as we kind of start out, the country risk is people don't really worry about. They're very positive on the merits of the GDP growth of the country, but all the money that Redford raises is mostly foreign institutional investors, and they only look at country risks. With the new stable government, that's had a very positive impact. The political mandate is very clear. That actually helps sell the country, which in a way is to raise dollars and makes the job of people who raise institutional foreign money a little bit easier. So country risk is actually perceived to have gone down. What people want to see is, as Shahzaad kind of entertained the idea of, as execution. And is the speed in which you can convert a positive sentiment of investing to an actual realized dollars, because they only look at dollar returns. And as we were talking about before, as my co-panelist mentioned, as the speed focus increasing and people focusing a little bit better and more professionalism coming to the market, we will see. We're seeing promises of execution getting better. We have delivery, and then obviously. There's been a few very good examples of people have done well. Our funds have done very well for investors. People are very excited about volume of sale of products. Now, I must say the urbanization and the commercialization, the growth of the market has created opportunities where some sectors are looking better than others. Let's just say if residential was a big focus for a lot of people looking at our portfolio of investments, they've been very excited about how the commercial uptake has been in the market. For us, for example, we've been, and Shobhit can tell a little bit more about how the market's been. The commercial absorption's been very strong in certain markets, and Shahzaad was saying residential market's been strong, and that's picked up, and that will manifest into a bigger attraction for investors. Now, will it be as big as 2006, 7, and 6 and 7? It's time will tell us.
Okay, Mr. Gupta, let me come to you. There is all of this has a manifestation on the buyer, and I think the biggest disconnect for the industry has been the fact that there has been a huge gap between what the buyer wants and what the seller is giving, or the seller is stuck with. What impact do you see this period of pain having, and how do you see the road to recovery from here?
See, basically, buyers are always wanting a safe deal at the lowest price, whether it is loans or whether it is real estate. But with the overhang in the inventory, I think the prices have been rationalized by being stable. In the meanwhile, as you know, that the rupee has depreciated, and the NRI's friends are looking at India once again with a very keen interest. But even the domestic customers, they have been able to sort of save more. Their loan appetite has increased because of affordability factor. Plus, the rates of interest have been stable. I would not say that the rates of interest for home loans have actually come down. A 10-15 bips correction is not really that the rates have moved downwards. So I would again go by that fact. One is, as you know, Shahzaad, Parry and Shobhit have been saying, developers have been now smarter in executing the project. So the pent-up demand over the last 18 months or 24 months have also resulted that the focus areas or the projects which a probable homeowner was sort of glued upon is nearing now completion or delivery. So that is also prompting people to make the decision of buy. And home loan rates have remained stable or have corrected. Affordability has gone up because of salary corrections and stability in employment. And I think this is a very positive indicator that the retail customer would be back in the market. And coming festival season, we are expecting, in fact, all home finance companies and banks are expecting their festival season this year to give a lot of buoyancy to demand and hence to the sales.
Vikram, do you also see some kind of reshaping of the industry itself with the whole focus on affordability, the whole focus on clearing inventory? Do you see a shift in the way developers are approaching it? And what are the 2-3 trends that you'd like to add to that?
Reshaping, Mini, would be probably a large word. But yes, because the inventory requirement or the demand in this sector is so large, yes, there is a lot of tendency for developers and a lot of fund houses who've been discussing with us right now to shift their investments on that side. So whoever is discussing residential for sure is definitely considering this affordable housing sector for sure. There are regulatory issues, there are issues of thin margins and stuff which they're trying to sort of work upon. But yes, there are a lot of people who've been talking to us in terms of getting into it. How long you need to stay invested, how large the project should be are the questions which they are addressing. But yes, there is a huge sentiment which says that we want to get into affordable housing. It probably will not give us results which we were expecting in 2005 and 6, but it's stable and I'll get my exits. So which is where I think the prudence of the entire industry is shifting to. They're looking at more liquidity of the investments than just bare large inflated returns.
Shahzaad, my question to you is that, at this juncture, the mandate seems to be getting things moving. We've had the REITs issue come up. Do you see commercial leading any sort of recovery at this juncture? Because, over there you have two advantages. One, prices are still off the peak of 2007, 2008. And moreover, you have the REITs coming in, which will allow a lot of people to bundle their projects and list them. So do you see some kind of revival being led from there?
I would think that commercial would be a good bet. And if you have a structure with a REIT, or you have investors who are willing to back a REIT, once a developer builds a commercial asset and can lease it out, and I think there is capability in the market for this. And I think there's a lot of capital waiting to come in.
A lot of the private equity money initially was also focused on the commercial side, wasn't it? I mean, if you look back legacy. So is this a good exit route for private equity funds? Because I know there are a lot of issues being raised on REITs, but what is your judgment?
It would be a great exit for many private equity funds, especially when you talk about commercial assets, you talk about retail malls, you talk about maybe some SEZs which were done. We have seen some movement in SEZs. We ourselves did have a fund which focused on ready commercial assets, almost like it was a REIT-like structure, and it mimicked a REIT, to the extent feasible under the current tax laws. But this REIT legislation, which will finally see the light of day, will, I think, give a very, very strong impetus to commercial development.
Shobhit, what is also being discussed is a massive shakeout. That somewhere the men will emerge from the real estate sector, and actually they will be sifting out of the weaker hands. Do you see that happening? Do you see a lot of asset sales going on right now? A lot of people focusing on clearing balance sheets, and is that working out?
No, you're absolutely right. If I were to sort of rephrase it, there is some amount of consolidation that is starting to happen. We've seen that in the last 2-3 years between developers. So really these are, sort of smaller developers trying to tie up with either the corporates or bigger brands. And I think as the market matures, it is a sign of maturity that, the brands get recognized. Today, people or home buyers are looking at quality, right? Just the way, you know, you want to go for branded goods, right? Today I want to buy branded goods, right? So as a result, today there is a sort of attraction towards large brands, and therefore you're finding that the market is sort of moving upwards, and there is the pyramid in terms of developers is shrinking at the bottom. Before this, you'd asked, and I'd like to sort of add to Shahzaad, we think that REITs are going to be a big game changer for the commercial market, and thereby impacting the residential also, because a lot of capital will get freed up. And I don't think it's going to be deployed back into non-residential, which means either commercial or retail or warehousing. I think it's going to go back into residential, and we will see more affordable housing products that will sell.
Parry, let me let you have the last word in this discussion. My question to you is that how have the rules of engagement changed between investor and developer in the last couple of years, and what are the hard lessons learned? What is the stuff that you will not do again?
Let's say for a boy who's done only 26 deals in the country and only 2 were commercial, it's been a very high weightage on residential in the last decade. I see that changing, and commercial, here's what drives the residential market. It's basically when you look at what they call the capital stack of a deal. How much equity do I need to build and deliver a project, and where does that money come from? And when you look at that, you realize in residential, you buy the land 100% because banks don't finance that. Construction financing comes from, if you price it well, from pre-sales and sales. And payment plans, and banks help subsidize, and a little bit from bank loans. So the capital stack, equity is actually way less than 40%. Now, if you look at a commercial, and I'm telling you historical perspective of mine, when you look at a commercial deal, the capital stack in India has been very difficult. Equity has been 60% of a big deal, which basically means banks will only finance construction loans, which they should, that's what's permitted. But the borrowing rates were so high, and they were high. They've been as high as 13.5%, and they've moved down. But when leverage ratios are low and equity needs are high and borrowing rates are very expensive, commercial supply takes a long time to come. And it's very risky, which means, as we talked about on this panel, but as the REITs have coming around, and we see that, now, the regulator, and we will see this conversation that's happened with us and several of the key players, has permitted what's they call the hybrid REITs, which will allow the REITs to own the assets as well as give a mortgage to commercial assets, which basically means the appetite for maybe returns or amortizing versus non-amortizing loans, their risk will be not greater, but their return threshold will not be the same, perhaps, and that will enable greater commercial supply.
Shahzaad, how have the rules of engagement changed through this period of stress, and what are your 2 things that you will not do again?
We won't get into greenfield development assets at a very early stage, or a land stage, unless we control the land. And we will work with developers who promise and deliver execution. I think if you have that, then you have a recipe that is likely to succeed.
And are you going to be more demanding to your developers and the
I think
people
so.
you've invested in? Because that was something which was a blind bet that many people did.
We took a blind bet at that time. There was a lot of lack of knowledge. Today, we have the experience base to work alongside a developer and add value to his business. And that's how we would approach the investment. And we would work with those developers who consider that as a great thing, that we work together so that we can generate higher returns for everyone.
Okay, so some tough lessons learned from the period of slowdown, but let's see how it pans out for all those people who bet on the real estate sector. Thank you so much for joining us, and thank you, gentlemen, for joining us.